Hello, everybody, and welcome to today's webinar series, the Tokenization of Securities. This is a 9-part series. This is webinar number 6. Today's webinar is subtitled Tokens, Standards, Chains, Custody, and Trading. We've teamed up with some incredible partners to help break down the tokenization of securities. You can see many of them on the screen here today. So I'm going to go around, introduce each one of our guests, give them a chance to introduce themselves, and then we'll dive deeper into this topic. If at any point in time today you've got any questions, comments, please just put them in the comment sections, and we'll be happy to get to those throughout the webinar, or for sure at the end. So Rachel, we're going to start with you. Welcome back to our webinar series. Always great to see you. Rachel Chia, she's the Chief Regulatory Officer and General Counsel with SDAX. Rachel, I think it's good evening for you. Welcome back.
Yeah, thanks. Great to be here. So as Chris said, I'm the CRO and the General Counsel of SDAX. I look after all the regulation matters at SDAX.
Thank you for being here. I'm Anthony Basili. He is the Head of Asset Allocators at Coinbase. Anthony, it's great to have you.
Yeah, same. As you mentioned, I lead the allocators business for Coinbase. I'm also helping to kind of spearhead our efforts on tokenization in terms of what that means for long-only investors like endowments, pensions, and others. So look forward to the conversation today.
Thank you. We appreciate your time. And Oyi Chu, welcome back as well. It's great to have you, the CEO of ADDX.
Hi, Chris. Hi, everyone. Really great to be back on this webinar series.
Yeah, it's been great content. So again, Oyi, thank you so much for being here. Simon Barnby, the CMO of Archax. Welcome, Simon.
Hi, Chris. Thanks for having me here. Looking forward to the discussion today. Yeah, I kind of run commercial activities here at Archax. For those that don't know, Archax is a fully FCA regulated digital asset exchange, broker, and custodian.
Thank you very much. Abitha Pidigala, he's the Vice President, Digital Assets at Goldman Sachs. Abitha, welcome. It's great to have you, and share a little bit about yourself, please.
Thanks, Chris. Hi, everyone. Pleasure to be here. I'm Abitha, as Chris mentioned. I've been at Goldman Sachs for over a decade now. I currently work in the digital asset team, focusing on everything DLT-based. Think about basically putting traditional markets onto blockchains, launch of our digital asset platform. So my background is operation, market structure, and at structuring as well. So look forward to the conversation today.
Thank you, Abitha. We appreciate it. Also, Hina Awan, she's the Markets DLT Vice President at JP Morgan. Hina, thank you so much, and great to have you.
Thank you for inviting me. So as mentioned, and very similar to Abitha, I work in the Markets DLT team, where we look at, on the public side, across markets products, how we can use blockchain to innovate, transform, and create new products in the markets world. Looking forward to the conversation.
It's great to have you, Hina. And another great friend joining us. Great to see him again, as always, Daniel Coher, one of the co-founders of Tokeny. Daniel, great to see you, and thanks for coming back.
Likewise. Thank you very much, Chris. Pleasure to be there.
And then the person that put this whole thing together, very grateful for him for doing this. We've gotten great feedback from people. Before I introduce him, I want to say thank you so much for joining us. Again, if you've got any questions or comments throughout this conversation, just put them in your comment section. We'll be happy to get to them. But the CEO of Inveniam, Pat O'Meara. Pat, thank you again for doing this. Let's jump in.
Hey, thanks so much, Chris. It's great having everybody join us, both on the webinar and also live streaming. And what I'd like to do is really just walk around and dive into kind of the issues, right? We're talking about the tokenization of securities specifically. And as we look at the tokenization of securities and what we're doing, there's a question of what are those tokens looking like? What are the standards that we need to develop, right? How do we need to think about that? What are the chains that we're using? What are the chains that we're using today? What are the chains we're going to be using tomorrow? Why did you choose the ones that you're choosing? How are you dealing with custody? And how are we going to deal with trading internally and externally, right? And so we have a whole bunch of great
Pat, I don't know if you can hear us. Go ahead. Okay, we lost you there for a moment, Pat.
Sorry about that. And so one of the things that I'd like to do, if we can, is really dive in. And we have a number of people who are innovators and leaders. And so what I want to do is, if I can, Oyi, I'm going to start with you. Talk to us for a minute For those who don't know your firm, tell us a little bit about your firm, and then talk to us about how you got started. You guys made an excellent choice for you around chain. You hard forked, created your own chain, and then that allowed you to handle the custody issues, very nicely out of the gate. So, can you introduce yourself and ADDX a little bit more, but then talk about those two areas if you can.
Great. Thanks, Pat. Great to be with everyone tonight. ADDX is a private markets platform. We started in Singapore about 5 years ago, and we went through the sandbox with the Monetary Authority of Singapore. And what was quite clear to us at the time, we were solving a business problem. And we were solving the idea that private markets should be in the hands of retail, high net worth, mass affluent. And we would really sort of saw the opportunity to use blockchain as an enabler. And so when we went through the sandbox, clearly the regulators in Singapore, as you know, were very progressive. And the idea was the regulators were basically saying, well, we're relatively tech agnostic, but you have to show us how you can comply with a securities license with a new tech. So so as we went along that path, even though we were on blockchain, we came to some conclusions, right? The easiest to get approvals from the regulators was to ensure that we understood what was KYC AML on the investor side, and how did we deal with securities as under the regulations, as it were, under SFA. And so we took certain paths, as Pat mentioned, we took a path to fork out Ethereum. We took a path to create a private permission chain, really to have a lot of control over who were the investors on our end, so that we can control the KYC and AML of participants on the platform. And also we wanted to build certain layers on top of the network, which is the compliance layer, the post-trade execution layer, which we felt, smart contracts need to be sitting together with different sort of microservices level. And we needed to really be able to adhere to what was the MES framework around many of the different securities regulations and the KYC ML regulations. We've been operating on that license now for 3 years. We've done a number of transactions, and in reality, we kind of realized that in an exchange format, sitting with a ledger format, it does require some level of complexity, because it's not just about the tech. It really also is about the compliance layer and the commercial layer.
Fantastic. And with your own private chain, permissioned chain, what did that do for custody and ease of dealing with custody issues out of the gate, right? And then the next question is, how are you thinking about custody in the future in a multi-exchange reality?
That's a good question. I have the solution for the first question. I don't really have the solution for the next question. But when we went into this and we designed it, I think the reality was, when we got our licenses, we got not only the dealing and securities license and the exchange license, we got a custody license. And so, custody to us, precisely because we can be very accurate about who owns the security, and we have done the KYC and AML of each individual and buy side, that actually custody becomes very much part of our business and very much part of the chain. And so I know we sort of say that and we take that for granted. I know the idea of the technology being able to create the custody solution, but actually you need to pair that with a regulated custody license is quite unusual. And so we think that the world going forward, especially after sort of what happened in the last quarter last year, is the idea that it's not just about the technological capability of custody. It is also about the license of being able to handle custody in a securities manner, right? So that's part number one. in a multi-chain environment, that's very, very complex, because that then opens up a big discussion about how does wallets actually operate across chains? How does that get regulators comfortable, not only about the buy side, which is the investor due diligence, but also about securities and the selling restrictions and the cross-border implications of how securities are moving cross-chain. And I think that's something that, because the technology never really enabled that cross-border transition. And today that the technology is enabling that cross-border transition, but the regulations are not really keeping up to it. So I think there's a lot of harmonization of cross-border securities that need to happen, because the tech actually can enable that to happen quite instantly. It really is about how do we then align jurisdictions, selling restrictions, and where the harmonization of securities rules actually need to happen over time.
Yeah, Oyi, and one of the things that I think that we're doing is in addition to this, what we call our blockchain hub, which is a utility that we provide third parties, and then also this custodial hub, right, where custodians can trade back and forth once something's been matched on an ATS. So you're not captive to self-custody or a single custodian, but in a multi-custodial environment, which is where we need to go. In the US, there's this famous footnote number 9 in the SEC and FINRA joint press release that says, in an atomic settlement world, a messaging system may in fact be a settlement and custodial function, which is very scary for a tech company. Do you know what I mean? We're like, whoa, we're just connecting custodians. But in atomic settlement, what does that mean? And how can you prove that every function that a custodial does that we don't do, right? In the equities world, that would be like a fix hub. And that this multi-custodial hub that we have, how are we going to do this? And as you said, what we're doing is we're trying to help regulators figure out, particularly in a multi-jurisdictional world, right? So thank you for doing this. And Simon, I'm gonna jump to you real quick. Archax, you guys are in London, Oyi's in Singapore, Simon is in London, and we probably should have identified, because we have people in Dallas and Paris and Singapore and New York and London. So I think we've got, and Michigan, right? So I think we got most of America covered, or most of the world covered, excuse me. And I didn't mean to bring you all on board. Sorry about that. And Simon, you're in the sandbox in the UK. You've had some huge strides in the last year. Why don't you introduce Archax for a minute, and then talk to us about how you're existing using the chain right now. But not only that, where are you going with permissioned versus permissionless, and kind of your digital CSD project that you've got ongoing in order to build something that's truly technologically robust.
Sure. Yeah. Thanks for that, Pat. And I maybe just give a little bit of context. As I mentioned at the start, Archax regulated here in the UK by the FCA as an exchange broker and custodian. And I guess the kind of the driver behind the Archax plan has always been that we could kind of see that the future of financial markets, all traditional financial markets, is ultimately natively digital. And so, what's been pioneered by cryptocurrencies in the crypto space, that underlying technology, blockchain, DLT, and concepts like tokenization are the future. And so for us, it's always been about, okay, we need to be the most regulated, the most institutional grade in everything that we do, because for that institutional wall of money to get involved in the space, you need to be you need to address both those things. So we spent the last few years building technology, getting regulated. The dialogue with the FCA, the application process was kind of 2 years from start to finish. So we've been doing that. We've been raising money, and we're now at the point where we're rolling out products and services for the first time. And the way we see the world is kind of a number of sort of vertical elements within Archax all linked together. So at the heart is really our exchange, and we have 2 segments on the exchange, one for regulated regulated tokens, tokenized assets, but we also, we can also have unregulated tokens like crypto too. So we have sort of two markets, one regulated, one unregulated. And then, on the custody side, the custody permissions that we have from the FCA cover, again, regulated and unregulated digital assets, but also client funds, cash, and actually traditional assets as well. So pretty broad coverage on the custody side. And with the broker permissions that we have, we don't give advice, but we can help firms raise money. So we have all those permissions in place, and as I say, the exchange is rolling out, the custody service is live, and we have a primary platform where we help firms raise money too. And but it's all been built to be blockchain agnostic. So we've tried to avoid aligning ourselves with any one particular chain. We've kind of will be driven by what people use. I mean, where we are today, the custody solution supports around 20 different blockchains. But in terms of where we're seeing usage, still a lot of people are using Ethereum, Polygon, Tezos, Algorand, Hedera, Avalanche. I guess they're kind of the main chains we see. But we're also big believers in standards. We've had many conversations with Rachel or Yi, and I was talking to Daniel yesterday when he came in the office here actually about the T-Rex standard, and so we're totally up for putting the right standards in place, as Yi said. To have these listings in multiple places, then you kind of need that in place. Here on our market, we can actually onboard issuances from all over the world. In the UK, you have this depository interest structure, which is kind of how you bring a foreign issuance onto a UK regulated market. So we have that capability in place. We have the permissions to do it, and we're onboarding a Swiss company, for example, at the moment onto the exchange here. And we are a centralized market. So with us, your tokens come into custody, we can see them. Your cash is in our custody, we can see that, and so trading is instantaneous and settlement is instantaneous within the Archax market. But it is all off-chain. And of course, that creates a slight problem, and you touched on this too, Pat, that at the moment in the EU and in the UK, if you trade on a regulated secondary market, then you have to hold the sort of golden source of books of records has to be held in a central securities depository, a CSD. And so we kind of find ourselves in this mode at the moment where we have these kind of beautiful, shiny tokens being held in custody, kind of as an on-chain record of ownership. And then we have to go and put a copy of that ownership into Euroclear Crest to satisfy the regulator. So it's not an ideal world. You have these sort of two separate sort of records of ownership. And the Montis subsidiary of Archax, which you mentioned, Pat, is kind of addressing that point. It's a separate entity from Archax deliberately. We've given it its own brand. It has its own CEO. It's raised some of its own money. So we kind of see it as being, it's not just for us, it's for the marketplace. It is building market infrastructure, and it is building a digitally native, multi-blockchain supporting central securities depository, a CSD. And that then you have one record of ownership. The record that's on chain is the same as the regulator's view within the CSD. So that's how we're addressing that.
Thanks so much. And when we think about this evolution and kind of where we're beginning and where we're going to end up, and what you're building, both from an infrastructure, how you need to keep it in-house for now. You don't have the ability to use multiple custodians, right? But that digital CSD is going to open the door for quite a bit of that, right? And it's super exciting to see what you're doing. But what we're seeing is this is going to change the concept of store of value, right? And I'll use Wisdom Tree, who's not on here, but where they're tokenizing their ETFs, and you're going to be able to do that. But whatever you're tokenizing, a fund, an individual asset that is a security, the ability for younger people to have their paycheck go directly into an ETF, a precious metals ETF, a 40 Act fund, a mutual fund, an alts fund. And if there is secondary trading in that alts fund on a monthly basis, the ability to put a liquidity facility against that, but then you can put a MasterCard and connect it up to an alts fund. You can connect it up to an ETF. You can connect it up to a 40 Act fund, which trades all the time. Suddenly, how people bank changes completely. right? It's how people store value has been fundamentally altered. And Abitha, I'm going to go to you on this one if we can. Talk to us for a little bit about Goldman. You talked about 22 markets. You guys have been in the news about creating your own tokenization platform on your own version of a DAML language, right? I believe you're looking at selling inside your own book to begin with, right? Inside your own customer base, where you're going to be doing that internally and then expanding outward. Talk to us about some of the decisions you made and the options you looked at as far as what did that token look like, why you chose to have your own chain. So can you hit that for us real quick?
Sure, Pat. So I'll start by saying that our journey began with the first issuance that we did for European Investment Bank, EIB, on a digital bond that they did on Ethereum. That was done in April 2021. And there, the technological partner, SocGen Forge, provided a tokenization platform for a digital native issuance, leveraging Ethereum as the underlying blockchain. And we were part of the syndicate. We were also collaborating with SocGen and Santander in order to get that deal done for EIB. Now, since that transaction in April 2021, what we've seen on our side is a huge interest from issuers as well as investors to explore this technology further. So we embarked in this journey of creating our own digital asset platform to essentially not only looking at traditional markets, but also looking at illiquids, which I think where we will see the biggest benefits of this technology in the forward. And I think for us, it's very clear that we're going through an evolution in the market at the moment, a bit like what happened in the 70s when we went from paper to electronic trading. Right now, what we're seeing is that transition from electronic to digital with DLTs and blockchain technology. And we're at a convergence in point in time where technology and regulation is converging to providing that transition shift in the market to push the technology forward. And it's very clear, at least from where we're standing here in the UK and indeed in Europe, the regulators are looking at this very closely. So, for example, in EU, as Simon mentioned separately, in the UK markets, there are regulatory sandbox that are being created to showcase the potential of the technology. EU DLT pilot regime, it's something that's going to go live this month, actually. That's going to basically bring together financial market infrastructures based on DLT technology. And for us, that's a really clear step forward in order to basically create a safe environment to showcase the potential of technology. Yes, there are some restrictions in terms of thresholds and sizing. However, you got to be able to basically demonstrate the potential before you can scale it up. I would add to this one thing that we haven't mentioned so far. We've talked about liquidity being a challenge at the moment, custody being a challenge, but also digital money. We call it digital money. So in order for you to get true atomic settlement, you not only have to have the security on chain, but you also need to ideally have the cash on chain. So having a form of central bank money or even commercial bank money on chain in form of CBDCs or tokenized deposits, respectively, that is going to basically be the step function increase that we will be able to achieve true atomic settlement. And yes, there are some regulatory sort of consideration we need to take into factor here, as Simon mentioned as well. You can't have true atomic settlement within the DLT environment when you sort of have this world of hybrid between fiat and DLT. So we're working through all the regulatory, legal, and technical challenges in order to basically scale our platform, which will eventually be initially a Goldman-led node hosting infrastructure, but we're looking to basically expand that out to other market participants, including custodians, other banks, and indeed investors and issuers as well. So that's kind of like a high-level summary of our digital asset journey and the platform that we launched in November last year. In February, we also did a green bond issuance in Hong Kong, which was the second bond that we did on the platform, and we look forward to basically expanding the product's features as well as other ancillary products such as repo, security finance, integrated with the platform as well.
And Abitha, you brought up an important point, right? For it to truly be an atomic settlement, you need DVD, delivery versus delivery, right? Versus DVP, delivery versus payment, where you have a cash leg, right? And there's some regulatory issues in there that whoever's playing can't many times use stable coins, right? You need a deposit, you need a CBDC or a tokenized money fund, right? And we see a number of tokenized money funds. You mentioned the tokenized deposits and CBDC. Have you been thinking internally about the tokenized money funds as a third piece that you can use in that DVD?
Yeah, we have been looking at tokenizing money market funds in a slightly different application, actually. So we are seeing a lot of interest from asset managers and other institutional buy-side clients that's looking to basically use tokenized money market funds in order to post that under the CSA of derivative contracts they hold versus us. So basically, that's essentially another form of an asset that these counterparties can post under the credit support annex of a derivative contract. And by tokenizing the money market funds, that's making that new product eligible to post as margining, VM margining under CSA. So we are looking at basically money market fund in tokenized format in order to basically satisfy those particular nuances there for capital markets applications.
Yeah, and we're, Daniel's been doing a lot around tokenized deposits and tokenized money funds. But Daniel, we're going to come to you. I'm going to kind of save you for last if we can, and as we hit standards. But Abitha, thank you very much. And I think that these issues about regulatory, what are the types of things that you clear and settle back and forth, these are incredibly important. Rachel, I'm going to go over to you if I can and talk to us a little bit about how important regulatory structure is. Talk to us a little bit more. Oyi brought this up. Tell us about SDAX. Tell us about the regulatory environment in Singapore and how that's enabling you to innovate and create something that is going to be transformational to the securities markets.
Yeah, sure. So I just want to echo what Oyi said, and I think platforms like ours have really benefited from Singapore's kind of regulatory position on this. So the MAS has taken a very tech agnostic approach to regulating securities and therefore like STOs in our case by not overlaying all the existing law with a specific DLT or tech specific kind of law. And I mean, when we're working with other counterparties and other countries that do have this issue where there's a conflict between traditional securities law and a DLT law, there arises some sort of like confusion as lawyers and regulators are trying to grapple with how the old world way of thinking of securities now transforms into the securities world. So that has actually benefited us as a platform, also in the way that we have evolved. We started in 2017, started first as a capital market services license holder, and since 2017 we have put on and funded 300 million worth of securities. And when we transitioned into also getting the RMO license, which allowed us to get onto a blockchain which allowed us to kind of open our digital assets exchange, and when we morphed into the kind of blockchain world as well, it wasn't a great difference because there was no additional like DLT law that we had to apply. It was simply the Securities and Futures Act and the securities regulation that we continued to apply in terms of the KYC, AML, and how we looked at the structuring of securities on our platform. So I think platforms like ours have benefited from this clarity of regulation. We didn't have to grapple with the kind of ambiguities between two different sets of laws, which some jurisdictions in Europe have had to because they put in a specific DLT law. So a little bit more about SDAX. Yes, we started off first in 2017 as a capital market services license holder, doing really like fractionalized investments, and because of our backers that had come in, which includes ESR and at that time ARA, which were very real estate heavy, as well as Straits Trading Corporation, which is one of the longest conglomerates in Singapore, also very real estate heavy. They started using us as a platform to put on real estate investments. So that now carries on into the world where we now have an exchange, and we're bringing all these fractionalized investments into the exchange as well to then address the issues of creating liquidity for what used to be illiquid. This is still a very nascent market, and like platforms like ours, we've still also been speaking with platforms like Archax and Oasis Pro. I think we're all in that space where we understand that the potential of this, where we can hopefully one day address that huge total addressable market of the prestige market to allow for these traditionally inaccessible assets to be in a fractionalized form to a larger pool of investors, and also hopefully one day address this problem of creating liquidity for what used to be illiquid. Sorry, I forgot what was your other question.
Well, it was about SDAX. Tell us about kind of who you are and you did that, and then the regulatory environment. And I guess a last question, Rachel, as you think about where you're going in the future, right? In a permission versus permissionless, right? There's a very I think we're having a number of talks with you about a multi-chain environment and how do you exist in a multi-chain environment with a master smart contract and the ability to exist in that way. And there's a very famous series of tweets from Vitalik talking about cross-chain versus multi-chain, and he was talking mainly about crypto, right, in this cross-chain challenge, but in a non-bearer instrument, meaning a security, multi-chain is much easier, right? Those concerns go away. What do you think about with SDAX as far as the future and existing in multi-chains, and what is that going to look like, and how are you thinking about this?
Yeah, so we like Oyi's kind of experience. We also started off with, well, we're still in this situation where we have a private permission blockchain. That was the kind of setup that MAS had preferred for exchanges like us when we first started. But we also see that that's not scalable. That's not going to be the future proof, right? As firstly, exchanges. I mean, a lot of exchanges are also not on chain. There's no reason to kind of conflate the two. We can separate the tokenization layer with the exchange layer and set up the exchange so that we can eventually trade multi-chain. And that's why we're also talking to various players like Tokeny and other tokenization as a service kind of players to see how we can work together to provide multi-chain. Because as an exchange, we shouldn't care where the tokens are made, as long as they're made to a certain standard, which Daniel can speak more about, as standards for token STOs like security tokens develop and more people make them to a certain standard, then the exchanges should be able to facilitate the trading of these. As an exchange and as a regulated exchange dealing with securities and fund units, we us to ensure that the kind of structuring of the underlying asset is in the form of security or fund. Because they are technology agnostic, it hasn't really mattered to them yet. It might change in the future, but it hasn't really mattered to them yet what kind of tokens these are in the form of or which chain it's made. Yes, they have, because we're at this stage of where we were and where we started, they encouraged us to do private chain. But we've also seen that they are being more open to having public chain tokens being created. And I think that MAS is also very concerned about this interoperability and creating not siloed pools of liquidity, but to have interconnected pools of liquidity as well.
And I think that gets single threading to one chain does create a single point of failure, and chains will fail. That is a fact. We don't know which ones will, but it's just a fact. Chains will fail. And the ability to be in a multi-chain environment and have underlying chains as a meta chain that allow you to go from one layer one to another layer one creates this redundancy that we think will be needed well in the future. So Rachel, we could not agree more with you. And Hannah, I'm gonna go to you real quick if I can. Talk to us about what JP Morgan's doing. You've been doing a lot, right? I'd love to hear about Onyx. I'd love to hear about your vision of your own chain, the future, how payments are going to play in. But you've been doing an enormous amount. And then maybe could you also weigh in on custody, right? Why did you go with Onyx? What does that mean? How is it being used inside the bank? What is the progress you're making?
Yeah, so I think our journey started off with the time when we entered this space, tokenization of securities. And what I mean by that is converting ownership rights to a token on ledger specifically, avoiding kind of native tokens because that's obviously still ongoing. But I think that had been proven as a point. And we've kind of gone past the proof of concept and we knew that we could do that. So we started looking into specific business use cases. And I'm going to mention here the repo product that we have, digital financing. And I mentioned that because Goldman's was actually our first external client on that. So we went live with that in 2021. But that was built on Onyx, as you rightly mentioned, private permission chain. And at the moment, all of the products that we're exploring are on the Onyx blockchain. And we've looked at that specifically from the perspective of we're a regulated institution. From a client perspective, they value, or we found they value the security that comes with that, of knowing that you have verified KYC'd participants on that blockchain, and those are the only people who have access to it, because obviously that gives them the security behind the technology. So the repo product, as I mentioned, and this ties into your point, Abitha, earlier, it is taking a traditional transaction and putting it on the blockchain by tokenizing the collateral, but then also by minting the coin into what we call a deposit liability, which is JP Morgan coin, which you might have seen in the press and whatnot. But that specifically is not a cryptocurrency, not a stable coin. It is just a deposit liability. It's cash on ledger. And that's one of the things that I think is really key for us to keep exploring further, specifically from an interoperability perspective. And I think this is where our focus is shifting from a bank perspective, especially. Whilst we are building out other products in the credit and the FX spaces, we are looking specifically on that interoperability and how that will work, because it's all very good and well, everyone building these niche business use cases, but until we can build that ecosystem to a point where it can interact, where we can move that cash on ledger, because like I said, we've got JP Morgan coin, but it only exists within the JP Morgan infrastructure. Until we get to that point where we can kind of move things cross-chain, then we're kind of limited in what we can do. And we have explored, for example, the hackathon that we did with HQLX, Onero, WeMatch, explored kind of doing those cross-chain repos, but it is just the start.
Yeah, and I think that your comment about the need to aggregate liquidity across silos is the whole concept of decentralization, right? We're not building another silo on blockchain. We need these tokens to be able to exist and trade interoperably in a multi-chain environment with a master smart contract that governs this, with observability of the compute function that is going to run whatever function is going to be run, as we distribute the transactions themselves, and then the ledger, right? So you need those things to be observable in a multi-chain environment, but as well, the source of the data that's driving the function, right? Particularly in the alts market, and so I think your liability representation as a depository token that can exist on multiple chains is, as you said, while you've done some work on that, when that becomes real, whether using, Tokeny, Onera, any of these fantastic players to tokenize in a multi-chain environment with a master smart contract with the ability to have total observability, literally that product will dominate Tether. Like everything will move from Tether to you instantaneously, right? And the reason is there's all question of liquidity is gone. You know what I mean? And so it's great to see the work that you guys are doing, and it is exciting to see when we're actually going to be able to connect those silos and aggregate that liquidity, right? That's what we're talking about. And I think, Anthony, that's what I want to go to you, right? I often use the example, and Hannah, I'm sorry that you're part of this, but I say that Coinbase reached 100 million customers about 120 years faster than JP Morgan did, right? And you guys got there really fast, not to say that slow and steady wasn't winning the race, right? But but you guys brought some massive liquidity and viral distribution into the market that GPs look at and they say, wow, I want a piece of that, right? And I often, we say inside Inveniam that we sell dull things to shiny people and shiny things to dull people, right? So to the crypto people, we sell infrastructure and data and how to get into regulatory markets. And the regulated markets, we sell, here's the infrastructure needed to get viral distribution, to create the possibility, the threat of viral distribution. And I think Coinbase, you leaning in to securities, is that threat or promise of viral distribution of a product set. And why don't you talk about Coinbase's role, your journey, how you look at the regulated markets, how you're leaning into tokenized securities?
Yeah, thank you all. Thanks, Pat. So I'll start with my journey. So I joined Coinbase in Q1 of 2022. So right before everything fell apart in the crypto space. So it's been a fun ride on a stormy sea for the last year. But I came in with clear eyes. I was prior to Coinbase, I was at BlackRock for more than a decade. Most recently running our pensions business for our ETF business there. And so, my whole thesis was, I think the product category of ETFs is a really good indicative example of how we see digital ledger technology and tokenization of assets playing through. Today it's a close to $9 trillion product category, really great products with low cost and a ton of liquidity, and they're used for all kinds of interesting things by large allocators. And so that concept of having a simple user experience in a digital wrapper is really easy for a large allocators to understand. And so we have a lot of conversations about that as we get them comfortable with crypto and digital assets today. So I came to Coinbase to focus on really that mission, and it's been extremely positive, and I've been really encouraged by the progress that maybe the security tokenization part of this whole experiment has really played through. So if you step back and you think about where Coinbase is today, in 2012 it was founded as the exchange, and so it was just matching buyers and sellers, trading Bitcoin and a few other tokens. That evolved over many years to the custody business in 2018, which then evolved into a multi-counterparty trading desk and a financing business, which is our Coinbase Prime platform. And as of our last letter, we had more than 80 billion of assets under custody, all crypto. Right, we don't do anything in securities today. It's all still just true crypto. The business has evolved to where we have a pretty massive commerce platform. We're facilitating payments for merchants. And this is an example of where we start to think about what we're all trying to do is we're trying to take the agency, autonomy, and efficiency of crypto, which lives on public ledgers, and we're trying to wrap it around regulated assets, which have to adhere to restrictions and constraints. And ideally, we want to bring as much of the freedom and autonomy of crypto to the regulated assets. So from our vantage point, we've built all the critical infrastructure that allows crypto to flourish, right? And it is the true freedom of movement of assets around the world without any hindrances. And so that's really positive. So from our vantage point, we have the critical infrastructure that allows for that environment to exist. And what we want to do now is think about the next evolution of Coinbase from exchange to qualified custody, prime business supporting funds and commerce to now, how do we then start to bring our 110 million, verified KYC users again into the crypto economy, and how do we enable them to interact with crypto that is true crypto and also regulated securities in the form of digital security tokens and other things. To your point, Pat, I think we don't want to build a system that is a bunch of silos again, right? We just our marketing team, part of the virality that you mentioned is probably most owed to our marketing team, which they come up with good stuff. So the QR code in Super Bowl, for example, that we just released a little video that shows a bunch of people who are frustrated with their payment service providers and different things. And, the whole tagline is it's time to update the system. And I think we can all get behind that when we call, XYZ company and we're frustrated that it takes 5 days to move money around for different reasons. So what we did, I guess it was about a week ago or 2 weeks ago, we launched our own blockchain. It's called Base. And this is an L2, so it's a layer 2 blockchain that's built with optimistic rollups, and it's EVM compatible, so it has all the safety and security of the Ethereum network. And our vision with that is, this is the next wave of how are we going to get our 110 million users who are on our wallet app and our thousands of institutional clients who are in our infrastructure today. How are we going to build a bridge so that they can safely and securely access the next wave of financial products, as I mentioned before. So what Base is going to come with is digital ID, KYC verified users with digital ID, so that when they go into Base and they're interacting with DApps, right, they can do so in a permissioned environment, right? And we're going to try to make it really easy for applications who build on Base to be able to integrate with our wallet standards, so that there's no doubt as to who you're trading with, but with full transparency, right? So I think these are really compelling things. And so our tagline for Base is "Come build on Base," right? So we want to make standardization is the theme here, right, Pat? I think it was a title of this whole thing, which is regulations is equivalent to standardization, and we're trying to figure out how do we standardize processes so we can reach scale. And I think we're going to try to find a nice happy medium middle point there in terms of the crypto economy meeting the regulated economy.
One of the realities is when there was deregulation of commissions in the traditional securities markets, the volume of trading grew so much that companies couldn't clear and settle their trades and reconcile their books on a daily basis. And the companies that grew, Pierce, Fenner and Smith, right? So Merrill Lynch, and ended up having 3 large brokerage firms brought to them because they could clear and settle the volume of trading in this new deregulated market, right? And I remember I was on a trading floor when we went to decimalization, and we argued vehemently against it because it hit my comp structure, right? Because fractions allowed us to charge much more. And decimalization, when we went there, it exploded the market. And we need the infrastructure because when you remove these rails, you're going to see liquidity moving through where there is significant ARB, particularly in these data-rich, low-frequency trading assets that trade with significant inefficiency. And then you're going to start seeing low-frequency trading, then medium-frequency trading, right, as you do this. And that's going to drive a lot of efficiency in markets. So you need the infrastructure to do that. You need all of these things, these various chains. I tell people, when I was at Bayer and I managed tech portfolios in the 90s, I could tell you the difference between Owens Corning fiberglass and Northern Telecom's fiberglass, what the bounce rate was, what the refraction rate, why one set of fiberglass was better than the other. Today, we don't know and we don't care. We just know there's fiberglass under our buildings, right? Mm-hmm. And the reality is the securities market is not going to make a bet on a chain. They're going to use many chains in order to achieve an outcome. And to do that, they need standards. And Daniel, I'm going to throw it to you, right? You have the only Ethereum-based standard that's been approved by the community, right? Talk to us for a minute about why you went to the work of building that standard, getting it approved. What is that standard, and how important are standards as we begin to seek to aggregate liquidity across all these great companies that we hear about, right? What role will standards play?
Thank you, Pat. I'm a big fan of analogy. So if you look at Formula One, they're all racing on the same tires, right? They race in multiple different tracks. Every week they change, right? So that could be your underlying network. And everyone around this table is obviously building a Formula One. What we're saying is that you don't necessarily have to rebuild the tires. So standardization is, I believe, important in order to achieve critical mass. And there are enough industry around us that went through this path. I spent 10 years in the telco industry, and you know that there were different standards between the US and Europe. In the US, it was the CDMA, TDMA. The problem actually in those phones is that there was no SIM cards, no identity. I will come back to that. So when you were basically changing phone, you had to change number as well. And there was no roaming, there was no interoperability. You couldn't send SMSs between networks. And this is actually why, SMS never picked up in the US. And then the US operators adopted the GSM standard that came with those normalization. And actually, the SMS business in US, after only 2 years, surpasses the one in South Korea, which was the #1 country in the world. So that gives you a good indication of what standardization brings. So if everybody's talking about liquidity, the only way, at least in private market, to achieve liquidity is to build standard that will create indeed a path towards connecting all those exchanges that are in reality centralized liquidity pool, but enabling them to connect all those liquidity pool between each other will allow to achieve this critical mass. What Tokeny has been doing for the last 6 years is to build that standard we would have been happy to use another standard, actually, if there was an existing standard, but there was no standard. Remember, 6 years ago, we started with those ICOs. That was the first time that this notion of smart contract was put into practice. Smart contracts is nothing but a DVD function, right? Deliver versus payment. And it was working pretty well on the ERC20, but ERC20 are not permission. So if I send you an ERC20 token, you will get it. Well, in a sense, it does what it's supposed to be doing. But if you're not supposed to get it, still, you will get it, right? And that worked well for utility token. But when it comes to regulated securities, where you need to enforce compliance, that doesn't work. That's why, if you look at all the experimentation that's been doing lately by large financial institutions, they've either been done in private chain, where you permission, obviously, the chain and you whitelist all participants. And on public chain, most of the experimentation has been done with the ERC20. And the purpose of those experimentation was just to showcase a transaction. So you give me your wallet address, and I send you a token, and you get it. That's good, but it's very much like having a Ferrari without wheels sitting in a garage. The moment that you need to use that token for something different than just peer-to-peer transaction, a peer-to-peer transaction when there is no need for compliance, then that doesn't work. We believe that what will drive the market forward is, of course, innovation. And innovation will be coming from public chain. There are 320,000 developers that are coding on Solidity around the world. That gives you an indication of what's going to happen in the coming years. So if you don't have a standard on which you can build, you will not enable to access your users to that innovation, which obviously for any large financial institution will be a major problem. That's why all those large financial institutions, including those around this panel, are working on EVM compatible solution. Even Corda, actually, R3. We were sitting yesterday in London with our colleagues from R3, and they are working on EVM compatible solution as well. And we are offering actually this standard to the industry. What we've been building for the last 6 years, we are open sourcing those smart contracts, making them available on GitHub. I'm officially announcing that we will launch a nonprofit association in Luxembourg, the ERC 3603 Foundation, in order to promote that standard globally with as large community as possible. We have already confirmation from the 3 major networks. I cannot name them for now. Once we need to officialize the association, we have the confirmation from 2 of the biggest asset managers in the world. And they are following our guidance on this standard because they know this is the only way that the market can grow. Anthony, you were absolutely right with referring to identity. The market cannot work with whitelisting wallet. It doesn't work. This is not compliance. I give you the private key. You become the owner of this asset. There's no KYC in between. If you lose your private key, you lose your asset. That is not a suitable solution for the financial industry. So all this, let's say, practical solution has been developed for the last 6 years, and this is what we will be open sourcing. Now, of course, some may ask, and what's the future of Tokeny if you're open sourcing new technology? Obviously, we believe that there is a need also to bring a level of compliance on the top of our standards. Obviously, we can offer you the smart contract. They've been audited. They work very well. But if you need to have also security compliance behind in terms of who can access specific application within your organization, then you need a SOC 2 certification. So we go one step forward by upgrading our offering to the market, to the institutional grade level that financial institutions need in order to operate those standards.
Hey, Daniel, thank you so much. And I think what you guys have done and what you guys are doing, full disclosure, I sit on Tokeny's board. Inveniam is a meaningful shareholder at Tokeny. We love what you guys are doing. Keep it up. It's fantastic. The industry needs it. We are at a time where we're going to go through and we're going to do speed rounds. I'm going to ask 2 questions real quick, and we only have a few minutes left. So I'm going to ask everybody to just run through and give us a fast answer. What's it going to take for us to achieve broad distribution and secondary trading and liquidity where we do aggregate silos?
It's a very good question that I wish I could give the answer to. And if I could, I would be a billionaire. It's that integration. It's the messaging between chains. It's, like we said, the cash on ledger, and something that any sort of solution that can support that.
Fabulous. Abitha, you got the same question.
I'll spin it slightly differently. I would say regulatory equivalency and regulatory consistency across multiple jurisdictions is what's going to enable us to scale institutional grade traditional markets on DLT.
Fabulous. Simon?
Yeah, well, obviously agree with everything Hina and Beetha have said, but to add to that, credible inventory. So, credible issuances, institutional grade issuances, that kind of inventory.
Oyi?
I think I agree with everyone. I think there's many areas that we need to tackle, but also, I think asset managers and the buy side need to just get on board, right? So the ecosystem needs to evolve. It's not just about banks and exchanges and basically digitally native platforms trying to talk to each other. It really is, how do we get TradFi and everybody involved in this conversation?
Amen. Anthony, you're up, brother. Same question to you.
Yeah, I would say, actually, I'll call an action to this group that I think Abita's comments around regulatory equivalency, clarity are the most important thing right now. And so, the more we can do to collectively bring our heads together and adopt what are the right standards and make sure the market understands those and they're safe for investors, that's the right thing to do.
Thank you. Rachel?
Yeah, for me, it's always the regulatory kind of harmonization across the countries, but also the key to finding the key to break so that we can get mass adoption by the masstige market as well.
Fantastic. Daniel, you're up, brother.
I already made the point about the standard, but one thing that we need to accept, beside everything that had been said, is that this is going to take a bit of time. So we need to be a bit patient. I think that the crypto hype has created expectation that everything can happen overnight. We're talking about migrating huge volume of assets. This is the most precious thing that banks have, assets and clients over this new infrastructure. So it has to be a step-by-step approach and process, and we need to accept it.
Yes, there's very good. There's a lot of wisdom in that. Thank you. And I think all this experimentation is fantastic. I'm going to go through and ask one more kind of speed question. I'm going to make a comment that I think custody is a big part. So I'm going to answer my own question. Custody solutions, as you said, Daniel, are a big part of this. We've got to get custody where we can handle this across the spectrum. Let me make one more question to everybody, and we're going to run through fast. What final point do you have to those who are on the panel and those who are listening? Where is the greatest opportunity still ahead of us that has not yet been answered by an incumbent that you see, right? When you look at this space and you say, oh, there's opportunity, et cetera, right? Where do you think people who are listening on this, on the podcast should say, oh, this is a problem that needs to be solved, right? So where is an opening to be solved? And I'm not gonna pick on people one at a time. I'm gonna ask, does anybody who want to go first on that?
Well, yeah, go ahead, Abida. Sorry.
Very, very quickly. I know we talked about securities, private markets, but I also think derivatives on chain is also a huge opportunity to streamline.
Awesome. Daniel, you're up.
Yeah, collateral. If you think of the amount of assets that are blocked in private equity, in real estate funds, that are from an operational perspective almost impossible to pledge. And the beauty with collateral is, unlike liquidity, where you need a critical mass and obviously an ecosystem, in collateral you just need a lender.
Anthony,
I think the greatest opportunity right now is partnerships. We all have deep moats in specialties in different asset classes and different elements of infrastructure. So the more we can do together is the biggest opportunity.
The ecosystem. Amen. Rachel.
Yeah, I was actually about to say partnerships. I think because we're such a nascent industry, we have to kind of work together to make this more widely adopted, and it's better if we work together.
Hina.
Very similar. Would have said the interoperability, but specifically those people who sit in between, because I think there are a lot of people who are building their own solutions, but the translations.
Thank you. Simon.
Yeah, I mean, I think the real prize here is traditional financial markets moving over to adopt this beautiful digital world which we're building, and so it's down to us to build this new infrastructure, this new world, and for them to see that this is the future and come and join it.
Awesome. Oyi, we're going to give you the final word of this webinar, and we thank everybody for participating. Oyi, where's the biggest opportunity?
I think everybody's covered a lot of ground, but I think, in particular, I want to sort of echo Simon, the buy side, right? I mean, the institutions, it's not just the retail and high net worth and individuals adopt platforms very quickly. It really is about the incumbents who are stuck in the very old way of doing things. I think there's still a lot of opportunity there to convert and make these buy sides sort of adopt, think about digitization and tokenization as the way forward.
And I'm going to wrap this up by just saying to everybody, thank you. It is interesting. We had private chains, public chain, cross chain, building for the market, building for themselves. I think we had a good cross section here. And I want to tell you, this is what the industry looks like. It looks like Tokeny. It looks like Archax. It looks like Goldman. It looks like Coinbase. It looks like all of these players, right? By type, right? And not just species, but by genius. So we've got to build the ecosystem. Thank you all so much.
Thank you.
Thank you.